Question for the panel. The chairman asked a question about can you achieve the increased capital requirements? My question is, can you achieve the increased capital requirements without negative consequences to the economy and to lending?
Senator, we do have concerns that some of the items in the proposal will lead us to either increase the price or to reduce the amount that we lend.
There's a chart in the NPR that looks deceivingly simple. It says, here's the RWA before the proposal, and here's the RWA after proposal. It says 24% increase. That is a reduction in the capacity of this industry to serve its clients. No questions asked. The capital that could have been used to create those additional RWA incremental has to be used to sustain the same activities we have today with no risk from the day before to the day after and what the enterprise does. That's the point we're trying to make, is that this is about using our capital, whether we have it or not, and whether we have it to meet the new requirements to support additional activity, not the old activity, which doesn't help the American economy.
Thank you.
I think one of the frustrations you hear from this group up here is this question should have been asked before it went out. There's no question. We have to hold 30% more capital than international banks in the United States of America for every loan. A lot of loans have now fallen between, have become unprofitable. So a lot of loans, when we talk to Bill, they don't make sense for our company anymore. Small business, CDFI, solar, wind, middle market loans, certain trades you do with pension plans, et cetera. The work should have been done beforehand. By law, the QIS was the qualitative impact study should have been done beforehand. We had 10 years to do this, and it's shocking to me that we're sitting after 10 years and we're talking about what's it going to do for small business, and we have to analyze it today. It shouldn't now. We all are going to fill hundreds of pages, thousands of pages of forms responding in a very detailed way to every single one of these things, but it was not thoughtfully done. I'm not sure it was shared fully among all the regulators. This should be relooked at.
And before I go to Ms. Fraser, my assumption is everyone's going to say, with consequences, that will be negative. So let me ask a different question to you, Ms. Fraser. The impact, and perhaps the unintended impact from Basel, the end game, on customers. We so often talk about the American consumer as if there's just one generic consumer out there. But from a state like South Carolina, where we have a lot of farmers, the impact on farmers and access to not only credit, but liquidity during the hard times. Can you perhaps give me a 30-second reaction to, will this have a negative impact on some of the rural communities that need derivatives? Will you walk me through that for a second?
Certainly, and thank you very much for your question, Senator. This will, to your point, increase the cost of borrowing for farmers and rural communities. It could impact them in terms of their mortgages. It could impact their credit card. It could also, importantly, impact their cost of any borrowing that they do. And let me give you an example. For a farmer, hedging your commodity costs and your commodity prices is an absolutely fundamental piece of providing stability and ability to sleep at night. Under the Basel III proposal, the cost of the derivatives would increase quite materially, and that would therefore have an impact on farmers' ability to do a fairly fundamental component of risk management. It could also impact their access to credit. So it's the cost of borrowing, it's the access to credit, and it's some of the fundamental tools that they need to manage their stability of their income.